So after these two fast and quick presentations, a question I think which many people in the audience has is how does factor investing fits in at the moment with the low interest rate environment we have? Please start, yeah?
Well, that's a very good question, because the low yield environment, is something, a topic, an investment theme that we are convinced that is important basically for every investor, right? So, and the answers are not that obvious. I mean, the first kind of possibility is to go into high risk, long beta space, but naturally that poses some risk questions. What we typically say is don't go that route, but rather into any sort of hedge funds, and particularly, of course, then diversify across managers. Typically, if that is feasible from an investor perspective, that's what we typically would recommend to do.
So, but to be concrete, I have a bond portfolio, Swiss bond portfolio with a negative yield to maturity. I want to get rid of that. What do you propose me now to do? Should I do?
So two answers. First, a side comment. The fact that interest rates are low mean the need for this type of solutions is much greater, right? So everyone used to get diversification between equities and bonds. And 2008, diversification failed. The one thing that did diversify was bonds. I don't think anyone, and I won't make you stand up, I don't think anyone thinks that bonds are going to be the big diversifier over the next 5 years, right? If there's an equity downturn, bonds have really got not that much upside left. So the need for diversification, for alternative sources of return, is higher. Secondly, my answer to you, what would you do? It depends how brave you are. The theory, and the theory is easy, is that you should go into a full cross-asset risk factor portfolio, which is, again, in line with taking in hedge fund style returns. In reality, it's limited to what peer group gap are you willing to have. So if you're willing to make a bet against your peer group, that's the way to go. But how far you go will not be limited by what is theoretically the best outcome, but it will be limited by your willingness to take risk as an organization versus your peer group.
And also the possibility how much alternative risk you can take. Not every pension fund can do that, given regulations.
Just a smaller comment, the level below, what we've seen in the last 18 months is the portfolios people have been using within risk factors have slightly shifted. So I think there's this general concern that maybe some of the more traditional carry trades, FX carry, some of the credit carry strategies, some of the rates carry strategies have become very popular as people look for those returns. And we've seen them get slightly less popular on the carry side and slightly more interested in hedge fund replacement factors. So things like mean reversion or merger arbitrage. So within the factor space, even the popularity of different individual factors is changing because of the interest rate environment.
Okay. So you mentioned now the FX carry trading in your presentation. So UBS doesn't believe that there is a risk premium for FX.
Correct.
Correct? And you do. How can that be? I mean, two large investment banks.
I do not represent the investment bank. I represent the asset manager.
Sorry.
To make that point very clear.
Okay, he represents us.
So I think a lot depends on your horizon as well, right?
Yeah.
So do we believe there are various premium in the FX space? Yes. Do you think you should be doing them right now? More complicated. So there's a long-term, short-term thing.
When I say risk premium, I mean there is no, what we mean is there is no systematic return for FX if you systematically take FX risk. That doesn't mean you cannot earn returns if you do behave in a well way. If you buy low and sell high, of course. But that's not a risk premium.
And for you, you see such a system.
So FX momentum is a well-performing risk premium at the moment.
Okay.
At the moment. Here I agree.
Okay. So now suppose you convince me that what I should do with my bond portfolio, that I made up my decision to use a factor portfolio which is cross-asset. The natural question is, what can go wrong?
Lots.
Yeah, almost everything.
So we've done this for a while. Lots went wrong. The main thing that goes wrong is people don't think enough about what outcome they want. That's our number one thing that goes wrong. So we talk about these utility functions. The chart I showed was a number of different utility functions. It's just a toolkit, right? There's no secret sauce. It's not magic. It won't deliver returns all the time and everything. It's just a toolkit. What typically happens is someone says, okay, this is what I want. Then you put together the factors, you combine them, and you deliver that. And they actually go, that isn't what I wanted. And let me give you an example. Corporate pension fund in the Nordics looking for a CTA replacement. So they asked for something with a minus 30% equity correlation. So we picked the factors, combined them. Equity over the following year went up very significantly. Guess what? Their portfolio went down. And we were like, look, it hasn't given up very much. The correlation's negative.
Yeah, what you wanted.
Okay.
So the biggest problem is not correctly defining your utility function and not spending enough time thinking about exactly what outcome you want. It will just give you the outcome. There's nothing magic about that. The point is when you get the outcome, you have to be happy at all levels of the organization, i.e. your management committee needs to understand what the PM's done and so on and so on. As I said, culture is the number one challenge.
Thomas, if you compare the maturity of the investors community in Switzerland in factor investing, if you compare it with other countries, how would you evaluate?
My view in Switzerland, relatively low, at least at this juncture.
And why?
At least coming from our approach, we say we have long-short portfolios that we can apply to client-specific benchmarks, which typically we then end up with in long space at the end. We have tried to go with long-short in the first place. We didn't succeed. Maybe well, that was years ago. Maybe this time it will be much easier, based on this approach. So we are in long-only space again. And then in Switzerland, with regard to institutional investors, typically when you talk about long, with this type of approach, with a tracking error of, let's say, 2% and an alpha of 1 or something like that, then you're in between a huge passive trend and what is left on the active side. And that is one, at least for us, one of the biggest, if you will, sales obstacles.
You share this view?
So Switzerland has taken a while to get going. The first markets were the Nordics, Australia, Canada, other parts of continental Europe. But literally beginning of last year, we started to see activity pick up in Switzerland. And I honestly think right now, Switzerland is the most exciting place for risk factor investing in the world. It is meeting the tipping point where it starts to turn. How these markets evolve is always the same. At first, everyone says this is a terrible idea. And then it tips, it tips, it tips. And eventually, if you go to the Nordics, unless you have a risk factor plan, you have career risk. Right now in Switzerland, if you are doing risk factors, you have a bit of a career risk. But it tips. And right now in Switzerland, we are just at that tipping point, or maybe 3 to 6 months before that tipping point. So right now, it's a very exciting place.
So is the shift in the attitude towards risk factors both in the next, say, 1-2 years?
Yeah.
Okay, but then a question which comes in mind is, so far, typically is qualified investors. But given that it's not correlated with the markets, why should it not be possible to sell it to retail investors?
Again, we do, where we, let's say, apply this approach to long. The systematic equity, the global equity portfolio that I showed before, that is part of one of the most successful funds we have, namely the Vita Invest. It's one of several. We have a multi-manager approach there. So that's the way to bring it also to retail investors, I believe. Because if you start, try and sell this type of approach to retail investors, no way. They will not understand.
So I agree. We're an investment bank, so we can issue products that track strategies and so on. We can't manage. If there is a manager picking between factors, and they happen to use some factors in that portfolio, I think that makes sense. If you're asking the end retail investor to dynamically monitor which factors they have exposure to, it doesn't make sense.
Okay. So are there any questions from the audience?
Yeah. Regarding the factor and the terminology, long before pharma and French, investors have invested in price trends, in value, in carry, interest rate-bearing instruments. And also today, investors almost have no choice than always be either long or short the factor, and that probably would include everyone that was still standing before the presentation. Now, this terminology of factors, are you suggesting that we should adopt this to have a cleaner conversation, what we talk about when we talk about different investment strategies? Or is it a suggestion to help our marketing because we can place it better when we use the term factor and sell it as such?
So I think if we go back to the very first presentation of the day, the McKinsey presentation, there were comments about efficiency in asset management and costs. The reason people are doing this is because they do realize that essentially nearly all investing is factor investing. But if you actually build it from the factors, it's much more efficient and it's much more cost effective. So I agree, the technology's there, people can use them. However, taking this approach where you isolate factors, pick the ones you believe in, invest in just those in a cross-asset portfolio, that's the most cost-effective way of doing that we've so far found. So it's really an efficiency and cost point.
Do you agree that because of historical data availability, in many factors you have a large cap bias?
A large cap bias? No.
No.
If anything, on the other hand.
And also, we have factors across every asset class, right? So you do have a survivorship bias, agree. And we do not think our back tests of performance are good indicators of future performance. And we do what we believe rather than what the data just shows, right? And so you've got to be super humble. You've got to not think you're particularly smart. Actually, this works best with people who think they're super humble and not very smart. If you think you're smart, you probably think this is too simple.
Okay. So, Thomas Rose, Tom Leek, we would like to thank you again for your presentations.
Thanks very much.